All right. Well, good evening, everybody. Welcome to our February 2026 Roundtable Golden Knight Awards. This is our program where we take just a moment and relive some of the magical moments of when we are absolute geniuses about stock selection. And it happens. It happens. Now, I kind of took the year off from anything resembling genius mode, but we'll get to that here in a few minutes. All right, so again, this is kind of our moment. February has traditionally been a month when we try to invite our friends and family to engage investing, and we've been witnessing a lot of that lately, and we really enjoy that. Tonight, we celebrate people who over the years have contributed to these presentations. You see all the names at the bottom. I'm not going to read them off, but they are in the correct order that line up with the photos up at the top. No, that is not my high school photo. That's actually an old Better Investing photo, but it's not from 40 years ago, those who accuse me of such things. But you can see we really treasure the participation of these individuals over the years, and those that are able to join us tonight, that's great. Again, this presentation will be on YouTube and archived on the Manifest site. So we look forward to making that available. And I say we go ahead and get underway.
Sounds good to me, Mark.
All right. This is our quick reminder that no investment recommendation is intended. This is entirely about education. It is a program sponsored by the National Association of Investors, known now as Better Investing, co-sponsored by Manifest Investing. And again, everything that we're doing here is literally taking this phenomenon, the modern investment club movement, and capturing the methods and techniques that we use to discover opportunities, share those opportunities, study those opportunities, and decide whether or not to deploy them in a portfolio. So that's literally what we're going to be talking about. It is absolutely up to you to make your own decisions about anything related to investing. So if we hold things in our portfolios, we'll try to remember to mention it, but that's a silly rule anyhow. But we'll do it. If you'd like event email reminders, you can actually go to the Mid-Michigan webpage at Better Investing and subscribe to that. If you'd like copies of the slides or if you have follow-up questions, our 2 email addresses are down there at the bottom of the page. Anything else, Ken, that we need to add or?
No, I think we're ready to proceed with the awards, Mark.
Okay, well, just real quickly, here's a quick status report. We basically track our performance versus the market over time. That's the graph that you see. The graph is literally the answer, how much is the tracking portfolio at the round table beating the market. And we've actually had a little bit of stabilization. We can celebrate that. We want to get back to that 5% level if we can. It appears after looking over the stocks over the last year or so that I should probably be put on vacation, and we should get some of the people we're going to talk about tonight to make more stock selections. And I think those blue dots might actually head up instead of sideways. So no, just kidding a little bit. The tracking portfolio is checking in at 16.5%. That's over 16 years. And beating the market by 2.5%. That's actually quite phenomenal, really. We'd like 5, but 2.5 ain't bad. We actually have seen a little bit of a resurgence in some of the medium-sized companies and smaller, faster-growing companies, and our performance accuracy has bumped up a tiny bit. We would like to see that in the 50s, but things are actually going pretty well. Again, we're not going to spend a lot of time on this tonight. Here are the top 20 positions by percent of total assets. Microsoft actually topped out at about $110,000 not that long ago. So it's actually dropped off a fairly significant amount in the last 2 weeks, along with all the other software stocks also. But these are the first 20. If you want to see all of them, as it shows right there, there's 129 active positions. You can go to that link at the bottom of the page and review them. That is a public link, and you can access the entire portfolio to see what we've been up to. Just in general, the report card, I'll give the abbreviated Reader's Digest report card, Ken. The growth rate of the portfolio is 11.8. As you can see, the average down here at the bottom, 11.8 is pretty good, but we'd like to see that just a little bit stronger if we can possibly identify some stocks that will get there. So this 11.8, we'd love to see that approach 12, 13, even 13 and a half. Quality is always good with a better investing portfolios at 81, and the projected annual return of the average projected return of the portfolio is at 12.2, and with the average stock market at 8, that's actually not too far off of being set up at least 5 points above the average stock. Anything that you would like to point out, Ken?
Well, nothing except the fact that you have been extremely busy the last month getting the new website up and running. And I know that we promised the folks that we'd be doing some more pruning of this portfolio for some very good reasons. There are stocks that probably don't belong in the tracking portfolio anymore. And we can make a promise that we'll try to get to that before spring turns to summer sometime. So we're giving ourselves a couple of months to get that done, but we will spend some time at a couple of bull sessions and maybe even at a round table in the foreseeable future and show you how we can do a little bit of pruning to maybe improve, especially that growth column just a touch. I'd love to see it up closer to 13% than closer to 12 where it is right now.
I agree, and we will be doing that. All right, so one of our principles that we lean on is that we all make each other better when it comes to this. It's just, there's absolutely no doubt about it. The sharing and discovery of ideas. I refer to our community of investors as formidable, and there's tons of evidence that support that. So we make each other better. All right, so let's go ahead, and I just want to kind of quickly go through these awards. We give out 6 or 7 awards, basically focusing in on the best picks of the last year, the best pick all time. Again, that goes back to 2010. Best accuracy, who beats the market most often in a given year and all time. We have a best picture award or a People's Choice Award. And then the best annual performance, who basically is picking the stocks which generate the best total return performance for the year. And then the same thing all time. So those are the awards we bestow. And Ken, I say we get underway.
Absolutely.
So our first award is for the best stock selection, the best pick made during a roundtable it's about the last 15 months or so. And you can see the roll call of previous winners. There's quite a bit of variety as to where they came from. I get a kick out of 2019 and Hugh McManus with Ardelyx. That's 7 years ago now. And Apple in there. How about that first one on the list, which is no longer on the planet? So, well, not as a stock.
Well, it's on the planet, just not trading publicly anymore.
It's just a different form of ownership, I guess. But again, a pretty colorful track record in history. So our first one is for, who picked the best stock in the last 12 to 15 months? And the answer is St. Louis's Candace Baker. She makes special guest appearances here as a guest damsel from time to time. And she quite often comes with a real powerhouse, and she did it again, Comfort Systems. And those of you out there, and I can hear the smiles, the internet smiles, including Ken. Those of you that own Comfort Systems, you know how much it's gone up. I don't think there's any doubt. And then you can see there have been some pretty good picks made in the last year. You will have a hard time finding my name on the list, but And we'll
I will tell you, Mark, that my investment club met last night, and we had a lot to say about comfort systems. We were going to sell a part of it because it's just had an astronomical run, and it's shaking up about 15 or 16% of our portfolio at the present time. But we were cautioned by our treasurer to be careful that we didn't register a short-term capital gain, which is taxed at normal tax rates. So since we bought the stock back in last February, we postponed our sale of any of it until this coming month, in the month of March, and then it will be a long-term capital gain for us. But we've owned Comfort Systems since last February, and it's gone from around $300, 320 something when we bought it last February, and it's gone to well over $1,000 a share right now. So it's certainly a great discovery if you got on the bandwagon early enough to play around with this data center provider of just basic engineering and basic construction.
Absolutely. And along the same lines, not exactly in the same business, but somewhat related, those 3 entries for Powell. I want to give a shout out to Colorado's Betsy Wills. Betsy will be here with us on the roundtable from time to time. And I'm grateful because I was able to sneak in and steal an idea a couple months after she presented it. So that's virtually my only presence on the list with one other exception. And I'd also like to give a shout out. I knew, Ken, I knew you were doing okay last year or over the last trailing year, but Cy, thank you. You're allowed to take at least a bow in several general directions.
I'm bowing.
Your insistence on keeping us well stocked with United Therapeutics has certainly been paying off, Cy, okay? And I even added a position back in a year ago last March. So,
yeah, it's an impressive list. And then look at Pathward Financial making the list. It's only a month old. I mean,
gee, who picked that one? Okay.
Yeah, look at that. Look at that baby go. That sets.
But I didn't get an audience nod for it though, Mark. You know that?
I know the audience is very stubborn, and they need to. They need to be more open-minded, especially when during the last stock presentation of the session would be a great idea. All right.
Let's look at our next award, okay?
All right. Oh, come on. I lost control here. All right. This is for best selection all time. And again, it's straightforward math. It's what selection has generated the highest total return or annualized return over the last 16 years, and Candace also gets this one. Now, Ken is objecting that he doesn't think that 1-year thing should be allowed to overpower some of the longer-term selections, but it's just the math, Ken. And keep in mind, if we throw Candace's Comfort Systems out, I get it. Well, no, I guess that's the same year also.
Well, I'm just thinking that I've remembered this award at various times, and it is tilted a little bit to the 1-year returns. It's easier to do 270% in 1 year than it is to do it in 3 or 4. So, but I understand the math.
Yep. Some wonderful names on that list going back over the years, too. Look at Hugh McManus's Bank of America back 10 years ago. And again, all the way back with TJX out of the box. One of your personal favorites at the time.
That's my second choice in the roundtable program ever. Just my second company that I picked. Yeah.
All right, pressing on. Well, who's been picking the stocks which most often beat the market? And for 2025, I knew he'd been definitely hot, and that's pretty hot. Nearly 70%. That award goes to Ken for the last year, and you can see some pretty reliable selections over time. And you just presented Ensign Group too, right? That's on the list.
Yep, that's a new one,
New one, and that's also cranking. So I hope you're investing some of your personal money in some of these selections.
I actually own the first one on the list, the second one on the list, the third one on the list, and the fourth one on the list. I own the first four on that list, Mark.
There
So
you go.
I feel good about that.
All right, so good solid performance for 1 year. So let's talk about all time. And this is a category that's been kind of owned by McManus. He has turned in approximately a 70% accuracy rate, 7 out of 10 of his selections lifetime. And he's kind of hard to unseat. So I'm going to need to get him back in here. Or maybe we give him his own category and create our own. But he's owned the category. That's over the lifetime, 65.8%. And you can see the names of the companies going back many, many years. Some very substantial selections over time. All right.
Well, Mark, if we had taken the contest more seriously in the first 3 or 4 years, we might be doing a lot better in that category. Okay.
True. True. It just took me a while to get warmed up. All right. So this category, we call it Best Picture or People's Choice Award. And how's that for a graphic, Ken? The old Microsoft balloon. Last year's award was for that Microsoft balloon, No Fear of Flying, and the periodic analysis we do on how much the Microsoft contribution means to the long-term performance of the tracking portfolio. And there are just some classic presentations. I might actually put together links to all those presentations because some of those are so much fun. I'm not going to talk about the 2010 edition again, but Hugh McManus' more Spock, less Kirk is just absolute classic. And there's a few others along the line that are pretty powerful. So that's the one that won last year. And this year we're going to go with the recent performance of Kurt. We have gotten all kinds of acknowledgments, cards and letters. Some of you have referred to his work as a masterpiece. It is a work in progress, and it's a wonderful thing to watch. We call it Renaissance and Discovery. You get a chance to take in one of his morning workshops. We're doing them on Saturday mornings periodically. And the next one will be, I think, March 21st. And it's just a whole lot of fun, and it's freewheeling. And it's just a lot of fun hearing what's on your minds, and it's really free-flowing. But there's some really good presentations on that list. Anything you'd like to add to that, sir?
No, but it's raising a lot of fond memories by reading a couple of these things here, Mark. I can't believe that it's been that long that we first presented Proof to the audiences, and that way back in 2019. So, yeah.
Okay. And there is Kurt. That's actually from last week at a conference. No, that's actually from, I think, 2008. Working with an investor at one of the Better Investing National Conventions on the upper left. And then those are the two recent presentations you may have heard mentioned if you're not familiar with them. Again, they're kind of free form, but they touch on some of the features of the website, some of the thinking behind it, and just an opportunity to tour and discover. All right. Did you have anything else, Ken?
Nope.
He's going to yell at me for that picture, by the way, but you can handle it. All right. So here, those two awards are, again, thinking longer term, but, who has had the best performance over the last year? Hugh can't win this one because Hugh has been working his tail off for the last year. He's been all over the globe, so we haven't heard from Hugh. Well, I hear from him, but he's not able to participate. But best annual performance in a leading role for this year, Cy Lynch. Cy basically has knocked it out of the park with his selections for this year. So again, take another bow, Cy.
Wow, I'm doing that. Thank you to United Therapeutics for going into consulting work. But
yeah, I mean, those are good presentations on United Therapeutics, and it's definitely helping out the portfolio. And good stuff.
I'm not sure any of us would have pointed to Pulte Homes, though, as something that was going to outperform.
You
Right?
know, I heard people that, and then maybe there's a lesson there that we should point out. I mean, I actually did hear some criticism about that one. And, and I'm like, I can remember criticizing other club partners' selections, at club meetings. I'd stomp off and go home and buy it myself or sell it or whatever. And I was always wrong. You have to keep a completely open mind when it comes to investing, be incredibly humble. And that always applies. Yeah, Pulte, I think it was a great choice. And it has panned out. All right. And last but not least, best all-time performance going back. And been a lot of winners of this award, and this one's going to surprise you. We all kind of hovered around. Now, I'm not going to say that I hovered in positive relative returns. I didn't. But everybody was kind of down around 0 or slightly positive. But Matt checked in with a positive relative return. Again, this is a lifetime thing going back to 2010. And Candace basically needs more at bats. So we're going to try to get her. She's definitely going to be here in either April or May as when we do our St. Louis thing. But she's just contributed a number of really cool stuff. And with Generac, she and I, when we presented it at the round table, we weren't wrong. We were just early.
So Matt's positive relative return includes Luminar, doesn't it?
Well, no, it actually doesn't. I should have X Luminar in there.
All right.
All of his other selections have worked out pretty well.
All right.
Oh, he's going to love that you pointed that out.
Just everybody wants to keep everybody else humble. It works pretty well for us, okay?
Yeah, but between the two of them, they have generated some wonderful
Absolutely. Absolutely.
All right, so in summary, it's definitely a St. Louis evening with Candace Baker. And Ken, I knew you were going to end up on the list this year because you've had such a good trailing year. And again, a tip of the hat and gratitude to Kurt for the stuff that he's doing. And Cy, strong year from Cy. So good time all around. So that's what's been going on for the last year at the roundtable.
We really hope that some of you have participated in some of the great selections that we've made, and we're honest enough to admit by publishing all of our choices that some of our selections are real stinkers as well. So again, make your own decisions before you buy anything that we recommend. Many times they work out, but I think anybody on the panel tonight would be the first to tell you that there are times when they don't work out. Keep that in mind. Ken,
I brought one a couple years ago to the round table. I'm not going to name a name. But, if I really liked it and we put $1,000 into it when it was $40 a share, we should really like it at 4 cents.
Next slide, Mark. Okay.
Next. Kicking us off with the steak. Go ahead.
I'm going to present a stock that's well known to an awful lot of people by their product. And this is Texas Roadhouse. It's one of the most popular fast casual dining restaurants in the nation, one of the fastest growing chains. And Texas Roadhouse is an umbrella name for actually 3 different restaurant names. They not only have the Texas Roadhouse, which is by far the largest number of restaurants in the chain, but they also have a restaurant called Bubba's, and they have another restaurant called Jager's. So you might see those two less frequently than Texas Roadhouse restaurants, but we're going to talk just a little bit about this company and show you an analysis. Texas Roadhouse began, oddly enough, in Indiana, Clarksville, Indiana, to be precise, in 1993. Kent Taylor who was the leading guiding light for Texas Roadhouse until his death, opened the first restaurant back there all those years ago. What are we talking about? Over 30 years ago now. And you can see that it was not nearly as flashy on the outside as they are today. He conceived the entire plan of the restaurant with a couple of business partners, and they memorialized it on a napkin over dinner one night, and the napkin's been saved, and it's now part of the archives for the restaurant. And that is the actual napkin right there with the design of the first restaurant written in just ink on a very difficult to write on medium. If you've ever tried to write on a napkin before, you know that it's not the easiest thing, but they put together a concept that's managed to do pretty well over the last 30 plus years. Next slide, if you would, Mark. Again, Jager's, Bubba's 33, and Texas Roadhouse are the three main restaurants of the 816 restaurants. And they're in 49 of the 50 states, as well as in one territory and 10 foreign countries. But of the 816, 744 are Roadhouse restaurants, 56 are Bubba's 33, and there are 16 Jagers. They are adding to that number in a nice, relatively consistent way. They're going to be opening over 30 different new restaurants this year, and they've actively been buying back franchised restaurants. Texas Roadhouse has discovered that they can operate their restaurants more efficiently and more profitably by doing it directly rather than franchising it to somebody else. So besides building new buildings throughout the country and the world, they are also actively buying back franchises. And the goal ultimately will be to have no franchisees left and to have the entire chain owned by corporate headquarters. Next slide. I don't normally pull a paragraph from value line and then underline something, but this is something that I found everywhere I turned when I was doing research about Texas Roadhouse. And Value Line put it in one nice, neat sentence, so I decided just to show it to you. This is coming from an extremely new Value Line from February 13th of this year, and they're making the point that Texas Roadhouse, during this period of relatively high food inflation, has made a conscious decision not to raise prices at the same level that food has been inflating in price. They did raise prices 1.2% in the last quarter, and they'll be raising prices somewhere in the neighborhood of 1.2 to 1.4% in this quarter that we're in right now. But food inflation during those same periods of time has been somewhere between 6 and 7%, with a big nod, especially to the price of beef. And if you're going to a steakhouse like Texas Roadhouse, that beef is going to play an important part in the food that is purchased to run the restaurant. Texas Roadhouse realizes that holding prices relatively steady will cost them margin points. That's profit. But they hope to, first of all, maintain their customer base. They hope to grow their customer base, and they feel, based on a lot of data that they're collecting, that that's increasing the loyalty of the customers that they have. They're trying to do everything they can to keep this a reasonably priced night out for mom and dad and their friends and family. They are consistently growing market share. The new restaurants especially are almost from the beginning of their opening very profitable, and same-store sales at the older restaurants have been increasing, and they've been increasing for the last 5+ years, which indicates that they are increasing foot traffic, and that's their goal at the moment for the restaurant. Next slide, if you would, Mark. You can see the pandemic. Most of the restaurants closed in 2020 and didn't reopen again until 2021. But if you knock out that pandemic year, which is very obvious from the earnings graph, you'll note that we really have very consistent earnings growth up through this particular year, and we have very consistent sales growth. It's actually been increasing a little bit over the pre-pandemic sales growth. The most recent 4 or 5 year growth in sales is higher than the growth from 2015 through the pandemic. Or through just before the pandemic. You can see the compression in margin is transferring to earnings per share, and you can see that earnings per share have been relatively flat for the last 2 or 3 quarters. That is expected to turn itself around and go back to a sales growth trend of around 12, 13, 14% going forward into the next 5 years. I've chosen sales growth numbers at 11% and earnings growth numbers at 13%. That 13 is below the projection being made by many of the sources that I dealt with in coming up with this analysis. Next slide. We're on the back of the stock selection guide, and of course I did strike the numbers in PE columns for the pandemic. They do not represent anything other than a very trying time. And then I've tried to come up with PE values that I'm expecting going forward. Everybody seems to be anticipating minor PE expansion for this company. So I've upped the average high PE for the next 5 years from the 5-year past average of 29, and I've upped it to 30. That's a very modest increase. And I've done the same 1 PE unit of tick upwards at the low PE, and the 5-year average, actually the last 4-year average was 19 at the low end, and I'm making it 20. That gives me an average PE of 25, and that average PE is right in line with almost all of the sources that provide me with a call on the average PE somewhere out near the 3, 4, 5 year mark. So I'm very, very comfortable with these 2 PEs. The slight PE expansion that everybody's anticipating for the company, and the fact that the average is sitting well within the boundaries being set by many other data sources. Next slide, if you would. I note that this company pays a decent dividend. I don't know if most of us are really aware that the average dividend being paid right now by the S&P 500 is just around 1%, and the average dividend being paid in the entire stock market is a little bit less than 1%. So the current yield of 1.7 based on the current price, giving me a yield of 1.7%, that's a pretty decent dividend to be getting when I kind of wait for the earnings to start to accelerate again. Notice that I'm seeing returns that are pretty decent. Let's go to one more slide, Mark. Manifest suggests that the par should be around 17. So I'm doing what I think is reasonable on the conservative side, and I'm getting my 17 up there at the high return using the forecast high PE. My par value is about 13%, and I'm quite satisfied with a 13% return for this medium-sized company. And I think it's a very reasonable analysis, not being too aggressive, but at the same time, giving a nod to the fact that people see a bright future for Texas Roadhouse. One more slide, if you would, Mark. I'm going to suggest we add $1,000 in roundtable dollars to the Texas Roadhouse portfolio, and I hope that you'll go out and take your significant other or your grandkids or your family and go out and have a pretty decent steak dinner once in a while at this particular restaurant, because I happen to own stock in this particular restaurant. Thank you.
Okay, Ken, are you providing your credit card number for us to go and do that, or?
No.
Right. Be nice. Speaking of nice.
Okay. Yeah, we're going to all be nice to each other. Okay, the next stock, what I'm presenting is NICE. This company is in the AI area, and they've been in the AI area for over 20 years. Today it closed down, let's see here. I wrote it on my piece of paper here.
14.20.
14, yeah, it's down to $14 and change. The bottom line is this company, I have been watching for practically a year because their 52-week high was like at 180, and it has gone all the way down with all the AI stuff going to 94.65. And like Hugh says, he likes to buy things when they're at a multi-year low. Well, I've been watching this stock, and it finally started bouncing up. And I was like, aha. And the RSI was nice and low. It had been lower than 35, but it's at 30, or had been below 30, but now it's at 35. And currently, because the 52-week low was at 94.65, I'm like, okay, it's hit its bottom. Is it starting to come back up? And I believe it is. Next slide. NICE is the cloud leader in powering AI in 3 specialized markets, and that is allows one platform of AI to build enterprises to design, build, and operate customer service automation. They have a digital evidence management and investigation platform for the criminal justice system, as well as they have a platform for anti-money laundering and fraud prevention for small and mid-sized organizations. So they've got 25,000 customers, and greater than 85% of them are Fortune 100 customers. So this is an international, they have international exposure to everything, and they're based out of Israel. I think the market has not evaluated the stock enough to recognize they have the deep history of been using AI for over 20 years. They added another platform to help their AI be better last year in September. And we're going to talk about that later. And they're a large company at $2.9 billion in total revenue, and the cloud revenue is $2.2 billion. So they're a cash generating company, not a cash consuming. And I admit I'm a little biased on that way. Next slide. For the fourth quarter, which was reported out in February this year, their total revenue for the quarter was $786, which was an increase of 9%. The cloud revenue was 14%. Their non-GAAP operating income was 7% and reduced only by 50 basis points. But, you know, of course, when anything in the market gets reduced, it gets slammed. And that's when I think things get thrown out with the bathwater. And that's when us as BI members, and Buffett says he likes to buy when there's blood on the streets. And I kind of really think that this stock is something a lot of people are overlooking. EPS was a change of positive 7%. Next slide. Mark, can you give me the next slide, please?
That is the next slide, Kim.
Oh, sorry. Okay. For the fiscal year, here are their highlights. The total revenue was increased by 8%. If you've got a big company, you're not going to have the big 15% growth. The cloud revenue grew by 13%. They have operating income was 7%. They had a little bit of a pullback in their margins, and their earnings per share was 11%. Next slide. So their cloud business is their backbone, and they've got a lot of backlog in their growth. And you can see by the slide that they have a 25% year-over-year backlog, and that's excluding Cognity. Now, Cognity is a new company that was acquired, and the acquisition was completed in September of 2025, and it cost them $995 million. So that took away from some of their free cash flow. But look at how the growth of the company has been from December 2024 of 2,543 million to 3,184 million. These glasses, I need to get new ones. They're growing even with all the AI, with all the disruption, even though the stock price has lost 50% of its value in a year. Next slide. Now, the big thing is, now granted, I got this from ChatGPT and how they worded this. Over the decades, because like I've said, they've been involved in AI for over 20 years. They're monetizing it and they're extending it with agentic AI. What that means is it is a platform that's for everything all together. So the CI data is the customer experience. So they have it from the entry level, the mid-level, and the high level. And when you have a company who's got this within a moat, that's called the switching cost. And switching cost is a very good moat because it makes companies very sticky. Because as that first slide shows you, they had a lot of reoccurring revenue. And reoccurring revenue is a sweet term because when you give it a sticky client and they stay with you, what happens is then you're able to, they don't want to change their platforms because it just costs them too much money. Now that revenue is is sold as the subscriptions and the services in AI, and it's a positioning across CCaaS. Now, granted, I've had to learn a lot of new terms, but that is contact center as a service. So whenever you call in and you have a question for whenever these companies are, you've got somebody who knows how to answer these questions, and you may not realize it's AI. So then I was looking up, tell me some of the modes of who some of their customers are. And I'm sure many of you will know this. One of their larger one is the Department of Homeland Security. They have Hendrick Automobiles, the Hong Kong Polytechnical University, those women out there who like to shop. How about Wayfair? They've got Citigroup, Harvard University, Southern Company, Travelers Insurance, and even Marriott. These are some of the companies that they have as clients. A lot of variety, a lot of different industries, and that AI is embedded in it, and people are not recognizing that they have invested so much money into these AI platforms that switching cost is going to be very difficult for them. So as they've invested so much, they're getting the cost benefit back because they have so much free cash flow. Next slide. Now see how the revenue is. It's 84% in the Americans, which was an increase in 6% year over year. And then they have it in the APAC and the Europe. So you have a company that is very diversified throughout the world as well as through the revenue streams. Next slide. Their gross margins, how can you complain with the gross margins for the last 3 years of the cloud of over 70% on average? The services they provide are 67 to 72%. That's nice and fat. And their product margin is over 80%. Fat margins means consistency, and they're doing very well with how they're allocating their capital. Next slide. Here's the reoccurring revenue as a total percent of their total revenue. 87%, 89%, 90%. It just keeps getting better. Next slide. So I did my SSG. My final numbers were here. I have it as a buy, and I had a sales growth of 10.5 and EPS growth of 10. I had the high PE at 22, and I had the low PE. I had used the low 52-week price of $94.70. So it came up with a buy at 6 to 1. The stock price closed like on the 23rd. It closed at 114.37, and so I compared that. Next slide. To Manifest, and what they felt was growth of also of 10.5, approve of 27.7, and a par of 20.5. So I hope everybody would consider to buy NICE as a stock of the month for the roundtable. Thank you so much.
Thanks, Kim. It's one that we're all kind of scratching our heads over, wondering when they will discover some form of recovery. And we'll be talking about that one in days to come. All right. One of my old favorites is back.
Yes. And speaking of recovery, you see near a 52-week low, near a multi-year low going back to at least 24. But notice those potential recovery figures, 40% in the next 18 months, according to Value Line Potentiality, and 12 to 20 over the next 3 to 5 years. And we'll unpack the numbers a little bit, but did just want to point out probably a major driver of that 52-week low is that while revenues increased significantly, our earnings per share actually declined a bit. And most recently, and due to employee expense, a little bit actually expansion of shares outstanding, and so I think that kind of spooked things. And then, of course, we also have, following up on Kim's mention of AI and Ken's mention of stakes not impacted by AI, I think insurance, nobody knows what AI is going to do. There's fears that it's going to wipe out agents because you'll, I guess, do your own AI searching. But then others say it's bullish because there's all kinds of new risks from AI that will need to be insured. But anyway, there's Brown and Brown. You could see definitely a high quality company deserving its 99 rank on Manifest. Next slide. And I think probably, let's see, we're now about 8 months or so past Mark's picking, and the stock has gone down some during that time. So I think it's time that we can now buy into it, knowing
you're
that
poaching.
Come around. Well, yeah, you saw. I think all of us had our fingers in UTHR, didn't we? And United Therapeutics. So it's
Well,
be a wise poacher. Be a wise poacher.
Cy, that was my second pick.
So, all right. But here you could see just a quick industry study and comparison. Excellent quality, highest quality in the industry, and at least of those with reasonable quality, the highest par value as well. Next slide. Here's just a summary of it. Been around for many years, nearing 100, I guess approaching 87 or so right now. They're an insurance agency and wholesale brokerage. So they're not an insurance company. They sell insurance related products and services. Primarily insurance products in the property casualty area, also employee benefits. Of course, that's protecting property. Casualties are protecting against essentially lawsuits or financial losses outside of property. And then they have non-investment insurance contracts and customized risk management products and services. Next slide. And to some extent, I think that's why ultimately insurance brokerages, while one could argue maybe you can use algorithms and use large data processing perhaps to shop for some levels of insurance. Not so sure that's true of actual risk management. I think you need some human touch there, although risk management also is data reliant, but that can be where AI is a tool rather than a replacement. The company is diversified in the insurance areas, but then it's a global company, quite large, 23,000 employees, 700 locations, 19 countries, primarily in the US, UK, Ireland, and Canada. Next slide. Here's a few slides from the company's fourth quarter results for 2025. Notice total revenue increased by the company's figures of 22.8%. You could get, I think, Value Line carries it even a little bit more by their calculations. The company is very acquisition reliant, acquiring smaller brokerages and bringing them into the family. They did a lot of that in the last year, and as you can see, they attribute 1.8 billion of their revenues to acquisitions. They have organic growth, which is a little bit of a negative or a con on the company of just 2.8%. That's insurance agencies and businesses that were in existence at the beginning of 2025, what they produced. Now, they also had revenue growth from some other areas, such as investments and the like beyond the acquisition. But super revenue growth, but as I mentioned, earnings per share actually declined. Next slide. In fact, I think that slide showed it. I didn't circle it, but and here's their overview. The highlighting on this slide is mine. Just that they said that they are very much economic business climate driven because when customers are growing their businesses and increasing their property ownership and the like, they have needs to purchase insurance for that. So for those items, and of course, employee related, they're in the employee benefits business, and so that too is business cycle dependent. And they're saying that economic expansion was good in the quarter, and inflation appears, surprise to be what's catching most people's attention. Rate increases, of course, is a way that they can make additional money while they're not collecting the rates like an insurance company does. They, of course, receive commissions. So the higher rates increases their total business handled, and their commissions go up. E&S lines, that's excess and surplus lines is really a difficult area right now. Notice the rates are declining, and they, I believe, in the looking forward, expect that they're still going to be tight. And they had a good quarter for merger and acquisition. And not only are they finding acquisition candidates, they're doing well bringing them on board. Next slide. Here was the closing comments looking forward from the report. Again, I'll start at the bottom here, just that they expect, again, another good year of mergers and acquisitions. So hopefully a good top line year, both from organic growth as well as acquiring additional brokerages and insurance agencies. Again, that E&S, the excess and surplus lines, which is a more specialized property insurance line, again, expecting to still have downward pressure on the rates, which of course puts a downward pressure on revenues. But overall, they expect that everything will continue to be relatively positive economic, with, again, paying attention to inflation and what happens in the labor markets. Next slide. Here's we go. I did not publish what Value Line said, but you see in the middle there, patience. Here, Patience Sai speaking, and Value Line says it this way: investors willing to exercise patience may want to consider this good quality equity. Indeed, at the recent diminished quotation, price horizon potential over both 18 months and the outlook to 2028 to 30 looks solid. We saw that on the very first slide when I mentioned recovery. I'm not exactly sure what Extremely is, but it's a good company. Very high quality, as you can see near the top percentile. Well, it is pretty much the top percentile in Manifest. And I have done what I call a pessimistic or a beat the stock up stock selection guide because the market hates it. Value Line, I believe, has the timeliness at a 4. I believe Schwab has it rated for the year ahead, I think, as an F. So talking about a stock that's not popular, that's why we're going to need patience. But I said, let's beat it up a little bit and see what happens. Of course, we like pleasant surprises. Next slide. Let's look at the numbers. I decided to go with a sales growth rate of 8.3%, which is essentially the Value Line rate. One reason I chose the Value Line rate, didn't think it was purely arbitrary, was, again, one of the red flags, if you will, for future revenue growth was that organic growth in 2025 of just 2.8%. Again, this is still a relatively fragmented industry. There are plenty of available acquisition candidates for insurance brokerage firms for them to acquire, and they believe that they still can acquire. They're not paying the report. I'm not sure the summary slides, I didn't highlight it, but in this latest report, they did say they're not seeing huge increases in acquisition costs. So growth through acquisition is likely to continue. And I had originally kind of gone with the consensus growth rate of around 14% based on history and analyst consensus and the like. But that includes acquisition. So I said, let's pull it down. Value Line generally excludes acquisition from their projections. So I said, let's pull it down to 8%. Then again, increase tax rates a little bit following Value Line's projection, leaving expenses at about the 5-year average, and shares to decrease just a little bit. And that gave me roughly $5, $4.98, well below the manifest consensus figure, and a little below, you can see the BI median consent, or the BI sentiment median of projections. Next slide. Here's the PEs, a high of 30, which is essentially the 10-year average, a little below the 5-year average. And I pulled 17, just the recent low rounded down, giving me an average of 23.5 that we'll see in a moment. Next slide. And here's the bottom line. Even with these somewhat less optimistic, perhaps even pessimistic, you could say, we're still looking at a potential rate of return annualized using high PE of 17, and still a very good rate of return, well above the market rate, using the average PE of the 23.5 times earnings at 12. So a very strong, high quality company, but we're going to have to be patient. They're facing headwinds, and it's not likely to turn around tomorrow. And then, of course, compare manifest par, which was in the yellow, which is kind of a signal to me, too, that it may be useful to do this beat up SSG a little bit and see what you can do. Again, manifest had significantly higher sales growth and earnings. Interestingly, came in about exactly the same on average PE, which was right in line with Value Line too. I think Value Line was 22.5 on PE. So I'm adding an additional $1,000 of Brown and Brown.
All right. Well, I'm going to cheer for you, even though it's going to help you more than me, but it'd be good to get a little price recovery on my selection. Good stuff. All right. Many of you out there in the audience are familiar with our annual stock picking contest known as the Groundhog Challenge. So this is just a slide celebrating that we are underway, the new contest. And I thought I would share what our community has picked as their consensus favorites. The numbers on the left are the number of times the companies were chosen, led by NVIDIA at 44, Halozyme at 42, Microsoft at 40, and then all the way down to Oracle at 15, Google at 15, and Schwab at 14. So basically built a dashboard so we could take a look at some of the key characteristics from top to bottom. And I would just argue that the consensus of this community has a really strong track record, running at about 7 to 8%, or 7 to 8 percentage points better than the market over the last approximately 10 years. So chances are there are some interesting ideas for further study in there, and I just offer that up as a shopping list. I'm going to use it as my shopping list, but I'm going to come at it from a slightly different perspective. I think this audience wants a fresh, new idea, not something that's recycled or beat up or all of those variety of adjectives you've just heard for the last several minutes. And I went through and I highlighted. In other words,
new trash rather than valued repeat.
Fresh tracks. Yeah, that's right. All right. So the ones I've got highlighted are already in the roundtable tracking portfolio. So I'm less interested in those. I think they're good companies. They are sorted from highest return forecast down to the bottom. And who doesn't like a 350% growth rate for their sales? So, I mean, you can't possibly go wrong with that one.
Yeah, That would help Ken put a smile on his face.
Well, yeah, that boosts your overall growth rate of the portfolio in a heartbeat. And Vital Farms has been featured here 4 or 5 times lately. They come out with an earnings report on Thursday, and Matt says he's buying drinks for everyone if it's a good report. So that's all well and good. But just kind of working the way down the list into it. I was kind of interested, but I heard that Ken's wife was not interested, so that's off the list. So we can scratch that one off. And then a couple more repeat selections there. Ken won't let us pick any more Ardelics for the portfolio. And I'm kind of upset with Charles Schwab and some of the stuff they're doing, so we're just going to skip over them. This one's kind of interesting, Mercado Libre. Microsoft we already have. Amazon we already have several times over. Interesting connections between the two or similarities. Netflix we picked. Adobe's in the portfolio. Badger, not terribly interested in these numbers are falling off, so I'm less interested as I go down the list. Owned Meta or Facebook from the IPO and haven't gone back. I'm not going to do it now. So I'm kind of zeroing in on the middle of that list. These are companies that are kind of in the sweet spot. They are in the sweet spot. And I'm kind of intrigued by a relatively high growth rate, a company that, it's not in the portfolio now, but you know what? It was 2 times in the past. And approximately 10 years ago and 8 years ago, I picked it. And it generated a 14 and a 16% relative return on the 2 positions. So I'm thinking maybe it's time for another shot at the basket. So Mercado Libre is the pick. Not in the current portfolio, so it's a fresh idea. A little recycled, but one with quite a heritage of success that we want to latch into. So this is, again, kind of the Amazon of South America. That's what they do. They basically ship stuff to people, but they're also very heavily into transaction support in terms of electronic transactions and moving from cash to e-commerce. You can see that they basically have Latin America and South America blanketed. They are headquartered in Uruguay, although their home country is Argentina. That comes with its own set of diciness. But one of the things I like to point out, I just grabbed a couple pictures from their literature. They have a lot of opportunity for this conversion. If you look at China, and for that matter, the United States, the amount of volume in non-cash denominated transactions. And then you look at the companies on the left, and basically they see the opportunity for that shift from the gray to the yellow as a very high potential opportunity in that area of the world. So they dominate the area. They're very present. And again, very strategic opportunity for them. All right, so one of the things I did, I think one of the key words here, I used it 10 years ago, this notion of scalability for a business like Mercado Libre. And what it really comes down to is adding customers and revenue generating activities without increasing infrastructure, staffing, and other operating costs. So you basically are scaling up quickly, growing rapidly when it comes to the revenue or sales end of the business. And if that grows faster than the costs associated, your profits as a percent of the business accelerate faster. It's one of the ways for earnings to grow faster than sales. We talk about it all the time. So that's what it comes down to, this notion of scalability, a concept that you really want to become familiar with. And it helps to avoid some of the blind spots that you run into with the traditional analysis. It truly is a powerful engine of compounding returns. All right. Well, we're going to see in a second here that 2019 through 2021 was kind of a rough spot. So I turned to Claude and I asked it that question. And I'm not going to read the answer to you other than to say what I am seeing here aligns very closely with the words that we used 15 or 20 years ago for Amazon. They match very, very closely. If you got to understand this notion of scalability and what seem to be operating challenges or problems, and what and I'll go down to this key takeaway down at the bottom, because Amazon said the same exact thing and was met with a lot of skepticism from the analyst community. But this notion of weak performance was a choice. It was a deliberate decision to build out the company, to build the infrastructure, to build the logistics network that is necessary to do the stuff that they're going to need to do. And every time Amazon got that question, you know, the earnings were erratic, 15 years ago. The answer from management at Amazon was, guys, we can make the earnings whatever you want. This room full of analysts, if you want $2 a share, I can make that happen. All I got to do is close a distribution center and lay off 4,000 people in Denver, and I can give you the number that you're looking for. That's not what we're here to do. And he repeatedly did that over a period of 5 years until finally they caught on that cash flow is more important than earnings at that stage in the company's life cycle. So what you're basically looking at is a repeat of the situation at Amazon, only was a couple years ago. So in retrospect, that period of time was building the company, not a threat to the company, as so many have painted it. So here's a look at the company. You can see the distress, or the seeming distress, around that 2020, 2021 timeframe. In fact, the earnings disappeared, much like Amazon's would have 10 years before that. But look at the sales. The sales are growing at between 20 and 30%, and they're pretty consistent. I think Value Line, that's what this number is right here, is probably even a little bit pessimistic. But you're talking about a company growing in the mid-20s with very consistent and reliable profit margins, a reasonable PE in the mid-20s for a company growing that fast, that leads to a projected annual return of 17, and then you can reconcile that versus a projected return on value of 12. Even if you knocked a couple points off the PE, it still is a very attractive situation, certainly comparable to what you just heard from Brown & Brown. So again, 12 to 15% for the return forecast, pretty decent looking picture. Again, the general consensus based on the auction known as the stock market is actually pretty affirmative. And in fact, through that entire period of tribulation was actually pretty affirmative. That's important. So there's a look at the cash flow. The cash flow has stabilized. You can see the investment. You can see that's basically the trough of investment that they were making, and the cash flow is taking off and doing exactly what they had projected. Earnings are returning. Profitability is stabilizing. The relatively low amount that they've had to borrow is borrowed at a decent interest rate. And, forget the PEs. None of these PEs matter. They don't count. Somewhere out in here, they're going to reasonably establish somewhere in here. And that'll make everybody that's now got the heebie-jeebies comfortable. But we are talking about a company that has, and here's Value Line checking in with their 16% forecast. This is a great picture. It's a tremendous field of opportunity for the company. And actually, I think it's a fairly exciting opportunity. So Mercado Libre, even if there's going to be diciness, going to need some size patience here and understanding, but I think it's worth adding to the portfolio again. And I'm going to hope for another positive relative return a couple years out and an opportunity to celebrate. Maybe we'll even get on that annual awards slide in the future with Mercado Libre. So
Mark, I have a question from the audience here that probably deserves at least the opportunity for you to respond.
Mm-hmm.
We've noticed in the slides that between the 2019 to 2021 period when they were housed in Argentina and the present day when they are now housed in Uruguay, does that give the company more stability going into the future?
I'm going to say I don't know. That would be, there's naturally more stability with Uruguay based on what I understand of the economics and the politics.
The currencies are certainly more stable in Uruguay than they are in Argentina. Yes.
It is a more stable situation, but they obviously cannot give short shrift to Argentina because they have an awful lot of client base there. So yeah, it probably has lended some stability, but I don't know. I'll dig in a little bit deeper and see if I can come up with a better answer, because I think this one may come back in the future too.
I'm just going to suggest that that might be the kind of question that one of these AI engines could at least give us a head start on, with a question about Argentina versus Uruguay. Get some insight from them. We don't normally think too much about the South American countries and the stress on their economies or anything like that.
Yeah, and
So
I took out the words that basically described the relative nightmare that Argentina seems to be recovering from. It was pretty bad. And yeah, there's some of that would be true. I would recommend to anybody that hasn't tried one of the engines, you could do it with ChatGPT or Grok or whatever. We use Claude for the Manifest Investing website. We continue to use it extensively. It impresses me greatly with some of the stuff that it's doing for us. So if you go to claude.ai, you can actually do a trial, ask this question, and then follow up with the question that was just asked. You know, how does the migration or transformation from Argentina to Uruguay impact the stability of this company? And see
our
what
audience
they
is
say.
our audience is wonderful in offering up a little bit more information, Mark, and we're getting a note from George Mackey in the audience that all the Argentinian business is only conducted in U.S. dollars. It's not conducted in Argentina pesos. So that might be a partial answer to what's going on in the Argentina part of the business.
Yeah, I would imagine that would lend a much higher order of stability. So maybe George can expound on that. But
Yeah.
George is a numbers guy. So
are we ready to go to the poll then, Mark, or do you have one more slide?
I am done. I like the
Okay.
company, and I'm very hopeful for it.
So give me a chance just to open this poll up right here. That's the wrong one. Hold on. This is the right one, and I'm going to launch our poll, folks. And we'd like you to pick one of these as to what you would like as the audience's choice in tonight's companies. They're all there for the looking, and if you really didn't like any of them, then none of the above is still a possible choice for you. And we do have a few people voting none of the above. Hard to please everybody, I guess. All right. While we're waiting for people to take a vote, George is indicating, Mark, for folks that look at first cuts, that he just submitted a first cut to Ann Cunez for approval, and it was approved, and it'll be published in the next couple of days. So if you're looking for a very current SSG from one of our community, look at the first cut studies, and in the next day or two, you should see a Mercado Libre study posted under first cuts.
All I can say, George, is great minds. Great minds.
I'd love to see around 90% voting. We're at 80% plus a little bit right now, so I'll give you another 10 seconds. It doesn't cost anything. It's free. Nobody knows who you voted for, so just give us a vote here. We're up to 82%. I'm going to talk it through for 5 seconds, then I'm going to close the poll. Can you push it to 85 at least, folks? We're at 83. Can you push it to 85?
88.
Well, I'm reading 83. Maybe it is 80. No, it's 84 now, Mark. So, yeah. So I am going to close the poll. And we don't have this happen very often, but I'm going to share the results. And we have a dead heat. Okay, I should have closed it before at 80 and then I would have won, okay? But we do have a dead heat here in second place. But Mark, look who came in first place right here.
Hey, Merry Christmas.
Okay, so we're going to put an extra $1,000 into Mercado Libre. And that'll give Cy and myself and Kim bragging rights when our stock beats Mercado Libre in the yearly program next year. Okay?
No, it'll go down 10%, and then one of you will swoop in and then claim it as your own.
Well, that happens also. So,
Sure.
and Mark, I'm going to hide this poll now. I think I'm going to hide this poll. Yep, and we're going back to your deck now, your slide deck. Go on.
Okay. All right, just a reminder that we do archive all of our presentations with the Mid-Michigan chapter and Manifest Investing on YouTube. You can actually access them there, or you can now access them directly at Manifest through the Events tab. You get direct access to all of these. You see those sessions that we mentioned about Kurt, the discovery session, and the Manifest Investing Tour back on January 19th. Those are both available here, as well as that 3-part series that Ken and I did on the Jamboree, the portfolio stuff. A lot of fun. Thank you to all the clubs that participated. But again, all the bull sessions and roundtables can be found there.
Mark, can I make a comment about the Jamboree portfolio session on the 31st of January, please?
Mm-hmm.
I've gotten a number of requests for people to have me allow them to contact the club that belongs to a particular portfolio. And folks, many of the investment clubs that we featured in the Jamboree are private investment clubs, and I don't feel comfortable giving them the names of folks in our community to allow them to contact the club. What I would suggest is that you post something in the forum on Manifest Investing if you're interested in talking with somebody from a club that had their portfolio featured, and if they're interested, then they will contact you through the forum as well. I just don't feel comfortable acting as the go-between between a private club and a person outside that club that wants information.
Yeah, I've had a few of those too, and I have contacted a couple of club representatives to see if they were open for visitors and or new members. But we certainly don't want to get into that business. Okay. Thanks, Ken. That's a good point. So where are we headed, sir?
Well, folks, our next event is our next bull session a week from today at 2 o'clock Eastern time. And we'll be doing bull sessions at 2 o'clock every Tuesday, as we have for the last 10 or more years now. We might be canceling the bull session on March 31st. I and my wife and Mark and his wife are going to be doing some vacationing. And our wives are a little bit prickly when it comes to taking vacation time to do things for Manifest and Better Investing both. So you might see us canceling one at the end of March, but right now next Tuesday is on, and we'll have a great discussion. Don't forget, if you're up at 9 o'clock in the morning Eastern time, that's 8 o'clock Central time, that every Wednesday at that time, the Breakfast Club for the Heart of Illinois chapter meets, and it's quite a convivial, very informal group discussion about lots of things pertaining to stocks. So if you're looking for yet more conversation, there's an opportunity for you.
If you attend,
we'll be running
I was just going to say, if you attend the Heart of Illinois Breakfast Club, you might want to turn your Limerick blocker on, your browser.
Okay.
Oh, am I in trouble?
We'll be holding another discovery session about Manifest Investing on March 21st, and that'll be at 10 o'clock in the morning. That's a Saturday morning. And we try to keep that to somewhere around an hour 15 minutes. It's a great time to get questions answered, to ask Kurt to do something a little bit different on the website. And he's quite honest. If he can do it, he'll tell you he can. And if it's something that's a little bit more challenging than just a quick fix, he'll tell you that it goes on the list of possibilities. Mark and I will be speaking in Houston on the 28th of March. That's a Saturday. And we're going to have a special beginner session at that event. If you're anywhere near the Houston area and you're just beginning to invest, or you have family that you'd like to entice into becoming better investors, have them come to the Houston event, where Mark and I will be running a beginners session, introducing them to the whole concept of better investing, manifest investing, and investing in general. Our March roundtable, because of our vacation, will be on April 7th. Mark your calendars now. That's a change of date. The National Convention at the end of April, followed by an April roundtable on the normal date, which is the last Tuesday in the month. And then we're going to be going to St. Louis sometime in May, and the date is still flexible. It's still being negotiated. But if you're going to be anywhere near the St. Louis chapter, we'll probably be spending at least a half a day, maybe longer, with the St. Louis chapter. And we'd love to have you in the face-to-face audience. That is really something that Mark and I look really forward to, is meeting you face-to-face. The whole feel of the educational event is different when you're actually talking to real people, not to a television screen. And we would love to do as much of that as we can. If you're in a chapter and we're within driving distance, give us a contact. We'd be glad to drive to your chapter and maybe set up some kind of a small program. We're pretty cheap, and we do a lot of the driving ourselves, which keeps the costs way down. So give us a call if you're looking for a program in the next year or so, okay?
Yeah, I've got the Punxsutawney Chamber of Commerce on hold. They'd like to schedule a meeting.
Okay, well, we'll consider that, Mark. All right. Do you have any other slides to go here, Mark? I think this marks the end of the roundtable.
Just wanted to say thanks.
A big thank you to all the people that are pictured above. These are people that have presented during this particular year, 2025, or before that. And the more people we bring into our presentation, I see that your picture has changed on the slide up here, Mark.
Magic.
That's a very good picture. Now you got to use my current picture over here for me, and we'll be all set then.
I'll slam these in there. And we'll try to clean.
All right,
we'll try to clean up globally too.
All right. So we wish everybody a good evening. We had a wonderful sized audience today and a very engaged audience. We thank you for coming, and as long as you keep coming, we'll try to keep doing these kind of opportunities and these kind of programs for you. Good evening, all. Thanks, Cy. Thanks, Kim. And Mark, always thank you for everything you do for better investing and manifest investing.
Most welcome. Take care out there, everybody.
Our pleasure, yes. All right.
Be patient with the snow. It'll stop eventually.
And spring training has arrived. And I'm on vacation next week.
I live in Michigan, and it does melt eventually. Good night, everybody.
Good night.